Welcome to the House Lux Estate, the channel that enlightens you about financial education and investment opportunities. Today, we're going to embark on a journey through the fascinating world of stocks. We'll explore 4 distinct types of stocks that, when combined, can create a balanced and robust portfolio. These are growth stocks, dividend or yield stocks, new issues or IPOs, and defensive stocks. Why are these stocks important, you ask? Well, they each serve a unique purpose in an investment strategy, and together they can help diversify your portfolio. Diversification, as we'll learn, is a key strategy to mitigate risk and maximize potential returns. So whether you're a seasoned investor or just starting out, understanding these 4 types of stocks can significantly enhance your investment acumen. Stay tuned as we delve into the world of stocks and their significance in your investment journey. To kick things off, we're exploring growth stocks. Now, what exactly are growth stocks? Well, they're shares in companies that are expected to grow at an above-average rate compared to other firms in the market. These companies might be in the midst of rapid expansion or developing a groundbreaking product. In essence, they're on the fast track to success. Growth stocks are like the sprouting seeds in the stock market garden. They're not fully mature yet, but given the right conditions, they could grow into towering trees. These stocks are exciting because they offer the potential for significant returns. If you pick the right one and it blossoms, you could see your investment multiply several times over. But it's not all roses and rainbows. With high reward comes high risk. These companies are often in highly competitive sectors, where the pressure to innovate and stay ahead of the curve is relentless. They also tend to reinvest their profits back into the business to fuel further growth, so don't expect dividends. Your returns will come from capital gains, which means you'll need to sell your shares at a higher price than you bought them for. So how do you pick a winning growth stock? It requires careful research. You'll want to look at the company's financials, its plans for growth, and the strength of its leadership team. You'll also need to consider the industry and market conditions. Are there any trends or changes on the horizon that could affect the company's growth trajectory? Remember, investing in growth stocks is not about quick wins. It's about believing in a company's potential and being patient enough to let it unfold. It's like planting a seed and waiting for it to grow, knowing that it could take years for it to reach its full height. Growth stocks, a potential goldmine for high returns, yet they demand your careful analysis. Moving on, let's illuminate the concept of dividend or yield stocks. These are a class of stocks that pay dividends on a regular basis. Dividends are essentially a portion of a company's profits, distributed to shareholders as a token of appreciation for their investment. They are like the fruit that a tree bears, a return on your investment that you can actually touch and feel. Now, the key advantage of dividend stocks is their ability to provide a steady stream of income. Regardless of what the market is doing, as long as the company is profitable and continues to pay dividends, you get your share. This makes them particularly appealing to conservative investors, or those seeking a stable income flow such as retirees. But it's not just about the payout. Dividend stocks are generally considered lower risk. This is because companies that pay dividends are often more established and financially stable. They have proven business models and a history of generating profits, which are good signs of a solid investment. However, like all good things, it's not without its caveats. When considering dividend stocks, it's important to look at the company's ability to sustain its dividend payments. This is often reflected in the dividend payout ratio. A high ratio could mean the company is returning a large portion of its profits to shareholders, which may not be sustainable in the long run. On the other hand, a low ratio suggests the company is retaining more profits for growth, which could lead to higher dividends in the future. So how do you find these dividend-paying gems? Well, a good starting point is to look at companies in sectors known for their dividend-paying culture. These include utilities, consumer goods, and real estate investment trusts, among others. To sum up, dividend stocks, the steady income providers, can be a haven for risk-averse investors. They offer a tangible return on investment, and while they may not provide the same thrill as growth stocks, they bring their own unique appeal in the form of stability and predictability. Now let's take a journey into the exciting world of new issues or IPOs. In the bustling marketplace of stocks, initial public offerings, commonly known as IPOs, are quite the showstoppers. They represent the first time a company's shares are offered to the public, often with much fanfare and anticipation. This is where companies, large and small, take the leap from private to public, opening up their ownership to everyday investors like you and me. But why should you consider adding IPOs to your portfolio? Well, the allure of IPOs is the potential for high returns. Picture this. You're one of the first investors in a company that skyrockets to success. Your initial investment could multiply many times over. It's the kind of story that investor dreams are made of. However, as with any good story, there's a twist. The world of IPOs can also be risky. The potential for high returns comes hand in hand with the potential for significant losses. Unlike established public companies, those launching IPOs may not have a long track record or proven profitability. Therefore, it's crucial to do your homework before diving in. So how can you navigate these new issues? First, understand the company. Dive deep into their prospectus, a document that outlines their business plan, financial health, and details about the IPO. Next, consider the price. Is the company overvalued or undervalued? This could impact the return on your investment. Lastly, keep an eye on market sentiment. The hype around an IPO can inflate the initial price, but remember, the excitement can fizzle out just as quickly. In conclusion, IPOs can add a dash of excitement to your portfolio, offering the chance to invest in a company's journey from the get-go. But they're not for the faint-hearted. New issues, while potentially rewarding, require your keen eye for detail and a well-calculated risk. So tread carefully, stay informed, and as always, happy investing. Lastly, we'll navigate the realm of defensive stocks. Picture a knight donned in shiny armor ready to battle. Now, imagine that knight as your investment portfolio and the armor. Those are your defensive stocks. These types of stocks are aptly named because they help to defend your portfolio against the inevitable downturns of the market. So what exactly are defensive stocks? Well, these are shares in companies that provide necessary services or products, things that people will always need regardless of the economic climate. Think utilities, healthcare, and consumer goods. When the economy takes a nosedive, these sectors tend to remain stable because, let's face it, people will always need electricity, healthcare, and toilet paper. Now, who might be interested in these kinds of stocks? If you're a conservative investor, someone who prefers to sleep soundly at night rather than ride the roller coaster of high-risk stocks, then defensive stocks might just be your cup of tea. They are typically low risk and offer steady, though not spectacular, returns. But here's the real beauty of defensive stocks. Their importance shines especially bright during volatile market conditions. When the market is a stormy sea, defensive stocks act as the anchor for your portfolio, providing stability and reducing the risk of loss. They are the steady hand that keeps your portfolio grounded when everything else is in freefall. But remember, just like our knight's armor, defensive stocks are not invincible. They can and do sometimes fall in value. However, their losses tend to be less severe than those of more aggressive growth stocks, and they often recover more quickly when the economy starts to improve. So, if you're looking to add some stability to your portfolio, it might be worth considering some defensive stocks. They may not be the most exciting investments, but in the midst of a market storm, you'll be glad you have them. Defensive stocks, your shield against market storms, are essential for stability in your portfolio. We've traversed the diverse landscape of stocks, each with its unique features and benefits. From the growth stocks with their promise of rapid expansion and potential for high returns, to the steady and reliable dividend or yield stocks offering regular income streams. We've explored the excitement of new issues or IPOs where the thrill of being in on the ground floor can result in substantial profits. And let's not forget the defensive stocks, those sturdy stalwarts which can provide stability in a volatile market. In essence, each type of stock plays a vital role in a well-rounded investment portfolio. The key is to strike a balance, to blend the high-risk, high-reward potential of growth stocks and IPOs with the steady reliability of dividend and defensive stocks. Remember, a well-diversified portfolio is your ticket to financial success. Thank you for joining us at House Lux Estate. Don't forget to subscribe for more financial education content. Until next time, keep investing wisely.